India's current account deficit went to 2.4% in the first quarter of FY19. This number is wider than the previous quarter, but one can choose to take heart from the fact that it was 2.5% in the same period last year. One of the reasons for the jump can be attributed to the weakening currency and, of course, the crude prices the way they are trading at. So where does all of this leave India's finances? What do you expect from the print coming up? And if all of this a potent cocktail for another rate action from the Reserve Bank of India come the next policy? Joining us to talk about all of this is Chief India Economist at JPMorgan, Sajjid Chinoy. Always a pleasure having him. Sajjid, so good of you to take the time out and speak with us today. Good morning. What do you make of all of these variables and the impact that it has on rate decisions from an India perspective, and then we of course move on to the Fed as well?
So let's just step back and try and assess what's been happening. I think what you've seen in the last 4 months is two distinct phases of stress. Emerging markets, after experiencing this Goldilocks environment of 2017, where global growth was strong, the dollar was weaker, capital flows were flooding in, the environment has become much more vitiated. And what you're seeing is essentially two phases here. The first phase, I would argue, somewhere from the middle of April to early August, was one where there was broad dollar strength. The dollar index was rising across the world. All currencies, the euro, emerging market currencies, especially those with current account deficits, were coming under pressure. So the rupee move in that period was largely mirroring dollar stress. I think what's a little bit more worrying is over the last 3 weeks, you're seeing a second distinct phase occur. The dollar index itself has kind of weakened or hasn't strengthened as much, but emerging market current account deficit countries, right? Countries that rely on external funding in this environment, Brazil, South Africa, Turkey, Indonesia, Argentina, India, have all seen their currencies come under sustained pressure, in a way suggesting that tighter global financial conditions are placing a risk premium, or markets are commanding a risk premium from those countries that need financing. So we have to look at the rupee move in a much more global context. This is not an idiosyncratic India-specific move. All emerging market currencies are coming under pressure. What's a little bit worrying is this is happening despite a weaker dollar. So in a way, we get a double whammy. We get a weaker currency, but because the dollar is weaker, oil prices are higher. So you get higher oil prices and a weaker currency. Let me just make two final points. One is that the rupee has not underperformed. There is this notion, which says India is the worst performing currency in Asia. That's an invalid description. We should be comparing ourselves to current account deficit countries. And if you look at the larger emerging market universe, India is kind of in the center of the pack over the last 4 months. We should not be comparing ourselves to Asia, which is largely made up of current account surplus countries, except for Indonesia and Philippines. Very last point, Neeraj, I think what you're seeing on Friday night is a continuation of US exceptionalism. Strong jobs numbers, unemployment rate is below 4%, but the most important part of that report is we're finally seeing wages pick up, right? The long-awaited increase in US wages, they went up 0.4% month on month, and a year ago, wages are now running at 2.9%. So that's going to create more stress here, because now more conviction that the Fed moves in September and again in December.
Sajjid, actually, so Akash Prakash wrote a piece wherein he mentioned that according to him, the markets by and large, or market watchers, are underpricing the impact of wage growth and the pace at which it comes, which might force the hand of the Fed if the Fed doesn't want to do it on its own. The pace at which Fed would go ahead and raise rates, and thereby the impact that it has on all asset classes. Now, we of course wrote about it from an equity watcher's perspective, but it naturally has an impact on all asset classes too. How big an overhang, if I can use that term, Sajjid, would that piece of the puzzle be for EM's macros at large, and for India and the currency in particular?
It will be a very meaningful headwind here. I mean, JPMorgan has been saying for a while that bond markets in particular seem to be kind of underestimating the pace at which the Fed is going to move. Till recently, bond markets only had 3 hikes for this year, a couple for next year. Our sense is there would have been 4 hikes this year and maybe 4 hikes next year. So the difficult juxtaposition is you've got US exceptionalism, that the US economy is roaring along and the Fed has to respond to growth, unemployment, inflation pressures there. At the same time, you've got a lot of emerging market stress. So I think this will be a meaningful headwind, because what you find is kind of, one of 2 things typically drive capital flows to emerging markets. One is growth differentials. The higher is emerging market growth vis-a-vis developed market growth, the more capital they attract. The second is the US dollar. So if the Fed keeps marching along, and that eventually causes the dollar to strengthen more, that is going to impinge on capital flows to emerging markets. And when that happens, current account deficit countries that rely on capital come under particular stress, which is what you're seeing in the last month. So this is going to be a very tricky, think of this as a kind of unraveling of the very benign monetary conditions for 4 or 5 years, where there was massive expansion of balance sheets around the world. Now the shoe is on the other foot, and some emerging markets with kind of softer underbellies, Turkey, Argentina, you're seeing the pressure in those markets. So it is going to be a challenging environment for the next 4-6 quarters, and I think emerging markets have to come back to orthodox policies, fiscal and monetary.
Okay, and I want, that will be my last question to you, Sajjid, but just before that, again from a global viewpoint, would India fare a little bit better, and with an assumption that some of the damage on the currency is done, maybe some is still left, and I don't know if anybody can really pinpoint as to what levels would the rupee slide down to, if at all, but let's work with an assumption that some of the damage is already done, and work with an assumption that at some point of time in the next 6 to 12 to 18 or 24 odd months, what is in the realms of conversation right now, which is India disassociates itself from being a part of the EM pack, which it has been for all these years, and starts getting looked at as an individual country to which allocations are done, because we are a reasonably large or a very large economy now. At some point of time, we won't be a part of the EM pack allocation, but an individual country allocation as well, and a country that is showing growth, which is fairly strong. I mean, the latest GDP print is reasonably strong as well. Does that help India cushion some of the pressures that will come in over the course of the next 4 or 6 quarters that you alluded to?
The answer in one word is absolutely. I think it's very important to make 2-3 points. Firstly, we should not panic. There's a lot of frenzied reporting every day about the rupee being at all-time lows. It makes it look like India is particularly vulnerable or the move is idiosyncratic. That is not the case. India's macro fundamentals today are much better than they were in 2013. Inflation is half the level it was. The current account deficit, I'll talk about that in a second, has gone up compared to last year. But even if it's 3% of GDP, it's meaningfully below the 5% we saw in 2013. It's very important that the fiscal be met this year, but the consolidated fiscal deficit is still meaningfully lower than it was, 5 years ago. And FX reserves are 1.5 times our gross financing requirements over the next year. That is not lost upon markets. India's fundamentals are much stronger than 5 years ago, and as you pointed out, growth, in a world where growth is at a premium, for a country to grow at 7.5 to 8% is very meaningful. So our fundamentals are better. But I think 2 points I'll make. One is, when you do have a current account deficit of about 3% of GDP this year, the first quarter was 2.4. We expect the subsequent quarters to increase. And you're looking at an $80 billion current account deficit. That will be hard to attract in this environment, not just for India, for most markets, because FDI flows are typically 35 billion. NRI deposits are about 15 billion. So 50 billion is your stable money. You've got an $80 billion gap. So there's a funding gap over there. Now that can easily be funded by a drawdown on FX reserves. We've got more than enough. So there should be no panic. But because India is a current account deficit country, in this environment, all current account deficit countries are treated as the same asset class. Once the initial pressure settles, what you find is markets become much more discriminating. And India's stronger macro fundamentals compared to some of these other countries I mentioned, South Africa, Turkey, Argentina, will shine through. India's growth premium will shine through. We just need to weather the storm by going back to first principles. To the extent that the rupee results in more inflation, we'll have to see a little bit more tightening. It's very important that the fiscal deficit be met this year and fiscal policy continue to consolidate, because ultimately the current account is nothing but investment minus savings. The faster we get fiscal consolidation, the quicker the current account will narrow without investment or consumption having to take a hit. The last thing I'll say, Neeraj, is that I would not regard the rupee move as being damaged, quote unquote. I think that in a way this is a healthy correction. India saw 20% real appreciation over 4 years. That, in my view, affected the competitiveness of the underlying economy. We've seen a 6 to 7% real depreciation this year. This is a healthy correction aided by global developments that over time will certainly help exports and help narrow external imbalances. So I think we've got the right policy mix. We just need to avoid panicking. And I don't think policymakers are panicking. So think of this as a global move, and when the stress does turn around, India's stronger fundamentals will show through.
Okay. Last question, Sajjid. An October hike firmly on the table, or do you believe it's a combination of things? A hike, some drawdown in reserves, and maybe raising some money via NRI bonds. All of that happens.
Yeah. So in this new equilibrium around the world where there are tighter global financial conditions, I think emerging markets have to respond using 3 instruments. Around the world, we'll see higher rates, tighter fiscal, weaker currency. I think that's the right policy mix, and I think that's what Indian policymakers are pursuing. The CPI print that comes out this week is going to be soft. It's going to be close to 3.5%, but largely on food prices remaining muted. That's water under the bridge. I think the RBI has to look forward and assess, with oil between 75 and 80 and the rupee having moved down, what are the inflationary impacts going forward. And my sense is the likelihood of a rate hike in October, if the currency remains under depreciating pressure, is very meaningful. I will say at this point we should avoid any ad hoc announcement like an NRI bond. As I said, India's FX reserves are more than enough. Any ad hoc announcement will just give the impression to global markets that, policymakers are panicking, things must be worse than they actually are. We don't need that. We've got plenty of reserves. Let's be orthodox. Let's tighten rates if we need to, stick to our fiscal, compress the current account, and if we have some drawdown in reserves, that's precisely why you have these buffers in the first place.